nothing is more stronger than a broken market trying to rebuild itself, right? On that thought, welcome to our Zoom web series hosted by One and PMS. This series is on the Juggernauts, where we're having conversations with uncommon and curious fund managers. My name is Jai, and I have today with me Manish Jain, who's the fund manager managing the Coffee Can PMS at Ambit Asset Management. Welcome, Manish, to our show. What we like to do with all our curious fund managers is first dive in with a jaldi 10, as we call it. So if you are ready, we'll just shoot off a few questions, whatever comes to your mind first, and hopefully there's a hamper at the end of it, right?
Okay. Done.
So how long do you think India will remain an emerging market?
5 to 7 years.
Okay. Are we at the bottom? The question on everybody's mind.
From a GDP growth perspective, yes.
Okay. Top down or bottom up?
Always top down.
Okay. What % of the times are you right in the markets?
So far, pretty much upwards of 80-90.
Wow. Okay. Perfect. One very interesting aspect that absolutely no one knows about you. Not even Siddharth, not even Sushant, or nobody else. Maybe not even your wife.
I have a very uncanny ability of switching on and switching off. I'm not obsessed. If I'm on a holiday, I don't even look at the markets. I come back after 10 days and then the first thing I'll see is what the level is. And I myself get surprised a lot of time. So when we talk about long-term investing, I actually truly believe in that. I don't really track the stock prices on a daily and a minutely basis.
Fantastic. With a market like this, I think vacations are out of the picture, right?
Yeah.
Perfect. Which sort of area, and not necessarily in it can be very wide, but where do you see the next innovation? Is it work from home? Is it something else that you're seeing? Where's the next innovation going to come from?
Supply chain.
Sorry?
Supply chain.
Interesting. What is the one thing, according to you, that people always get wrong in the markets, or there's always a misconception that you feel about the markets that everybody has?
Timing the market. People always get it wrong. Okay. 99% of the people buy at the peak and they sell at the bottom.
Sure. Diversification in equities or concentration in equities?
Concentration.
So let's say, how many stocks should be in a person's portfolio?
Ideally, not more than 15. Ever.
Okay. Double down or double up?
Double down.
Okay. The biggest red flag that you see in stocks, or you look out for stocks except for corporate governance?
Typically, things related to balance sheet, annual report, intercorporate deposits, receivables. So it has to be something related to annual report and accounting.
Okay, fair enough. Are you a contrarian trader or a trend following trader? Investor?
Neither.
Interesting.
I follow my gut and my belief.
Okay. And how would you rate the research on the street that is currently available on a scale of maybe 1 to 10, where 1 is really poor, 10 is really great?
90% of the time, it's about 5 to 6.
About 5 to 6. Okay.
There is one report once in a while which comes out which is really good and informative, but most of the times it's just for the sake of it.
So define once in a while, once in a month, once in 6 months?
So you'll see, 2 or 3 interesting reports in a year.
Okay. So once in maybe 6 months. Interesting. And would you call yourself as an optimist, pessimist, realist? How would you define yourself? Optimist. Super. So I think that your coffee with current hamper should be on its way with, as soon as this lockdown sort of gets over. And talking of the lockdown, do you see it getting over on the 3rd of April or 3rd of May?
No, not for Bombay. I think Bombay, Delhi, these are serious threat zones, the red zones, if I may call it. And I think the earliest, in my mind, I'm seeing Bombay opening up would probably be sometime in June. And I'm assuming the pan-India situation goes back to normalcy or starts going back to normalcy by somewhere close to September, October maybe. And things go back to complete normalcy probably by the first quarter of next calendar year.
Understood. So that's a quite a wide this thing. Do you actually see we opening up, locking down, opening up, locking down, or there will be a more sustained period of lockdowns and opening up, or it will be
I think
a W shape?
it will be in phases. See,
Okay.
the point is, we've done a wonderful job so far. Think of it, most people, don't realize it, but in a country of 133 billion people,
Huh.
1.33 billion people, to have just about 500, 600 deaths and just about 18, 19,000 infections, I think is a fantastic achievement given the density of the population that we have. And I think the authorities have done a wonderful job. Kudos to them. And if you look at it, I think what will now start to happen is, based on the order of importance, the things will start opening. So agri probably is the highest on the pecking order. So that will open up first, then supply chains, essentials, etc., etc. So we'll keep going down like that. But, for example, cities like Delhi and Bombay, which I said, would most likely open up somewhere close to early June or maybe mid June. Even then, things are not immediately going to go back to normalcy. What you'll see is, offices, for example, working at a much truncated capacity, more and more people for an extended period of time traveling, working from home, traveling less, attendance in the office being somewhere close to 25 to 50%.
Sure.
Travel is something that I don't see people undertaking in a very long time now, at least not in this calendar year. I see too many people starting to travel for work. So all those issues will remain. Then
Right.
again, if you go off work and in personal life, I think multiplexes, malls, etc., etc., will take a long time for that fear psychosis to go away. You might be sanitizing, you might not be sanitizing it, you might be
Of
doing
course.
all sorts of things. But I don't see people flocking to the mall at the first day, when things open up. I don't see all of that happening. Travel,
Got it.
tourism, hotels, they're all going to take a significant amount of time. See, what you got to realize is what is happening to us has happened after 102 years, right? So something like this of this magnitude happened 102 years back. And the information flow at that point of time was much lesser. So the carefulness that people have and the fear psychosis regarding their own life that they have is much higher today. And that is
Sure.
why the time period, I think, is going to be much more extended.
Fair enough. Fair enough. So, and if I can get you back to the PMS that you manage, which is the Coffee Can PMS, and I think you guys have done a wonderful job. It is one of the top rated PMSs on PMS card. If I could just ask you to give a brief as to what has been the edge, right? What is the USP that has led to success? Because we've seen, especially in the month of March, we've seen PMSs are down 50%, 40%, etc. Right? While we're not saying that, what has been something that has separated the Coffee Can PMS from the street?
I think just one thing, which is sticking to the philosophy. See, when you sell people an investment, instrument, there is no guarantee for a return, right? You're not promising any return on paper.
Sure.
Uh, what you're selling to them essentially is a belief, is a philosophy. And I think the biggest mistake people typically tend to make is to deviate away from the philosophy, deviate away from the vision that you sold to the investor. And that is the biggest mistake. And I think the biggest challenge for us, or me personally, in the last 15 months, have been to walk away from so many money making ideas. I can think of at least 8 to 10 where we have just said no because they did not fit into a framework.
Right.
And that, I think, is the biggest challenge, and that is what separates the good from the bad, is that not to get lured for easy return, easy money, not to chase beta, but to stick to the belief, the philosophy that you've sold to an investor. See, 5 years down the line, if I don't give you return, I'll come back and say sorry. There are a multiple number of factors which may determine the return, may not determine the return. But what I'll always do, and something that we'll never deviate away from, is to go away from the philosophy. If I sold you a belief, a thought process, I'll always stick to it, come rain, hail, or sunshine. And I think that is
Got it.
what has worked for us.
Understood. Understood. No, that I think sticking to that process, as you are saying, I think obviously when an emotional market like what we are seeing right now, where there are deep cuts across a lot of stocks, I think it's obviously very important to stick to the process that you have. And in that process, if I could just probe a bit more and ask you, what is the general holding period? What has been the shortest time that you held a stock? When have you changed your views? Why have you changed your views, etc.? Just if you could give us more flavor on those aspects, that would really help our audience.
If you look at Coffee Can, it has been in inception since 3 years in the PMS format. And pretty much so far, what we've done is we've sold just one stock out.
Okay.
Yeah,
Okay.
so that's the all the churn that you have had, and you have seen. We've bought three new stocks and we've sold one out. So it's not about a set time frame, right?
Sure.
But the fact is that when you buy an idea, you have to be convinced about the past, the present, and the future. You have to take a all-encompassing 360-degree view, which starts top down, but then goes up, bottom up, and etc. You take a full view. But then eventually, over a period of time, what you got to keep a hawk eye on is the fact that whether the company stands true to the philosophy or the story or the ideology that you invested in, right? Are the corporate governance practices keeping up? Has the business model changed, shifted? Is it still the same? To determine whether the drawdown that you're seeing in terms of profit decline and etc. are these cyclical factors, or is there structurally something going wrong with it? Accounting issues, have they started creeping up or not? And whenever you feel that something is wrong in any of these, and there can be a number of red flags, right,
Sure.
which might not necessarily lead to some other fund selling it out. For example, receivables shooting up dramatically. For example, auditor payment shooting up dramatically, right? For example, change in revenue recognition. Any of these could actually lead to an exit from Coffee Can. So we are very paranoid about protecting the capital and safety first. And the way we keep the investments safe, returns come secondary, is by actually ensuring that the quality remains intact through time. And that is what has always worked for us. So it's more about the company, the corporate governance, the quality of management, in which you have invested. And as and when that shifts, you exit it out of it. But otherwise, if everything remains on course, then you stay invested in a name.
Understood. And Manish, this is more of a sort of a personal question. When did you start, believing in the sort of the coffee can philosophy? Or even if I have to put it sort of in a more tangential way, what sort of prompted you and when to enter the stock market and, get enamored by, trying to make money out of it?
So, to be very honest, equity research is where I had started my career in sell side, and that was the first job off the campus in a company called StratCap Security. So, for almost 15 years of my life, I was a sell side research analyst, but slightly different. Typically, if you think about it, sell side analysts have a 1 year vision and they have 1 year target prices, and they are more driven by quarterly results. I was slightly in a different mold always. I used to think long term. When you look at my key ideas at that point of time, also were Britannia, Nestle, Asian Paints, right? Which were all long term. They were all 3 year, 5 year ideas. And I used to stick to the guns even when the cycles used to go wrong. So quarterly results are bad. What do? You buy more, right? And I've seen this in number of cycles in Britannia, for example, in Asian Paints, for example. And, about 15, 16 months back, when the opportunity arose, I thought it was an ideal juncture in my career and in my life to jump ship from sell side to buy side, right? Where you are earlier advising and now you are actually putting your money where your mouth is. And so far, it has kind of worked well for me. But
Okay.
inherently, I think the philosophy has always been in the coffee can mold, not exactly coffee can, but long term thought process has always inherently been there.
Fair enough. Uh, one of the areas where I sort of at least differ from a lot of people is that I inherently come with a philosophy that each strategy has some kind of lifespan, right? Because from what you are saying, the coffee can should be easy to follow. The processes, the rules are sort of out there. There are books written on it, etc. Uh, why are people still not be able to make and follow the way that you guys do it? Or is there a lifespan to this strategy? Are we going to be talking 10 years later saying that, Jai, we don't have the coffee can anymore. We have a tea can maybe.
Yeah. No, I think coffee can has a fairly long lifespan at the moment. I mean, see, the point is quality never goes out of fashion, right? Quality will always kind of survive. So as long as you're quality conscious, even in a developed market like US, had you invested in a stock of Apple, 7, 8 years back, you would have made tons of money over there as well. So that's not something that I'm too worried about. But I think discipline is a key over here. See, the point is it's very easy to be complicated but it's very, very complicated to remain simple. And that's what we do, right? To walk away from ideas which make money. I can tell you in financials, for example, there are so many ideas which we identified in Jan, Feb, March, which a lot of our competitors actually, included in their portfolio at that point of time also. And those stocks from there went on to become almost 2x. Some of them were 2.5x, right? And through the time, we kept our conviction that it doesn't fit into Coffee Can framework. We are not going to buy it,
Sure.
irrespective of what your projection of return is. And today, when you look at February and March and a little bit of April, those same stocks are all halved.
Right.
Right? So they've all gone back to a year-old prices, and they'll probably fall 30% more from here onwards. So it's about sticking to that discipline when the times are good, right? When you stick to the discipline when the times are good, it's the dividend that you get when the times are bad, and that's what we believe in, and that's what I think separates us from everybody: discipline.
Sure enough. One of the things that, in our conversation with different people, most likely investors, has come up is that, yeah, I've always found it easier. I get sold into a great fund manager speech, a great idea, and, I'll enter at a point where, okay, I've made some money, but I've never known how to exit that PMS or a mutual fund or a stock, right? Can you throw some ideas out there, saying that, look, if this particular thing happens, you might want to get out of a Coffee Can PMS or this mutual fund or out of the markets.
Sure. Sure. Now, and this is something that I always tell people, is that it's never about returns, right? Eventually, if you invest in any asset class over a very long period of time, there is going to be a return that is going to be associated with it. Somewhere it is going to be 2% less, somewhere it's going to be 2% more. But your money will make money for you. So return is a byproduct. It's not the primary aim. The primary aim that every investor should keep in mind is, what is the purpose of investing? Why are you investing that money? Right? And that is where the portfolio approach to investing comes, is that certain portion of your money should be there in liquid. It is to meet your emergency exigency needs, right? And certain portion should be in a really long-term illiquid instruments. Some portion should be for your retirement planning. Some portion of your investment should be for generational wealth transfer, right? So every portion of your money, every bucket of your money or asset class should have a certain purpose attached to it. And then you try to match that purpose with the instrument. Right, and that's a mistake people make. Now, for example, public provident fund is a great investment avenue, right? 8 to 9% compounded return over a 16-year period. But if I invest my liquid money in public provident fund, and something, God forbid, something happens, I need that money immediately next day, I don't get it. What is the use of that return? It is useless, right? So you need to match it up with that. Even if your liquid money is not generating any return, as long as the capital is safe, you should be happy. So that, I think, is the most important thing, that to have a purpose in mind.
A well thought out sort of blueprint on asset allocations is what you're sort of talking about.
Absolutely.
Perfect. One of the other things that, when, before we did this exercise, we obviously polled a few people that what would you like to know, from these fund managers, who've been done and performed well. And a lot of them want to sort of, dive into your mind and ask, saying that, look, what was that opportunity that you saw, which was very obvious, but not a lot of people actually saw it?
Well, that's a very interesting question. For example, I remember, now this is not something I can relate to as a fund manager, but something that happened almost in 2007, 2008.
Sure.
When I was still a research analyst, and there was a company by the name called Asian Paints. It was about $600-700 billion in terms of market cap. Forget Nifty, it was not even a part of Nifty Junior. Very liquid name, trades less than $1 million a day. It used to trade back then. And it was always perceived to be a commodity play, right? Nobody ever saw paints as a frontline consumption play back then. And I remember the overall markets used to be somewhere close to 12 to 13x. The most expensive stock in the markets back then used to be HUL, which was between 22 times to 24 times. And I initiated research on this name in August 2007 with a price target of with a target multiple of somewhere close to 26 times, which is a premium to the most expensive stock that traded at that point of time in the market. And I remember the morning meeting. All sell-side houses typically have these morning meetings, right? It started at 9, went on till 1:30, and people were baffled out of their wits. What exactly are you trying to sell over there? But the point is, that was a conviction that I had, that it is a consumption play. It is more about repainting rather than fresh painting. And when you look at the industry penetration levels, right, there is a certain need to it. And if India is going to continue to become affluent, this is an industry that is going to continue to do well. And here you have the market leader. So it's just as simple as that. Right. My investment philosophy has always been very top down. It has always been very common sense driven rather than very number driven. Numbers come much later into the picture. And that's where the conviction was there. And in my lifespan, I've seen Asian Paints become 20 times,
Sure.
primarily driven through earnings and not through multiple re-rating. Another story, if I may, is Nestle. I upgraded Nestle on the day when the Maggie controversy broke out, and the
Oh,
stock, I
really? I didn't know
remember,
that. Okay. Very interesting.
yeah, it fell down to 5,400 that day.
Sure.
Yeah, and there was an existential crisis on the head of Nestle because almost 20% of your revenues are coming in from that one single brand.
Right.
And everybody knew that the packaged and processed food industry was never going to be the same ever again, right? FSSAI is now going to have a very prominent role to play in it, whether
Right.
you agree with the controversy or you disagree with the controversy. But to have that conviction and that vision from a long-term perspective that the branded players are going to benefit more than the unbranded players. And here is a company which is a market leader in 4 different segments: infant nutrition, coffee, packaged and processed food, and number 2 in chocolates. You have a winner at hand. This is an opportunity that you pick the stock up rather than panic. So I can go on and on about these stories. When management change happened in Britannia, for example,
Right.
when Varun Berry came on board, Berger, for example, is another one. Pidilite is a fourth one. I can just keep going on and on about these stories.
Fair enough. So let's say, let me put you back. Let's assume today is 2007. Uh, uh, if not a stock specific, what sector are you seeing which can potentially have those benefits that 20 times in my lifetime?
Definitely, even now, I would say consumption. Even
Okay.
now, see, the point is, if a country like India is going to grow, right? India is going to grow. Forget 2021, but the fact of the matter is, from a long-term perspective, we are going to remain a growth economy. Now, you can debate whether we are going to grow at 3%, 7%, 8%, 10%. That's a different matter altogether. But the GDP per capita of 2000 is going to go up. And one thing that has always remained consistent from time eternity is the aspiration in the mind of the people to lead a better life, right? That has never gone away. So
Sure.
as affluence continues to happen, as the GDP growth rate continues to happen, people would want to do 2 things for sure. One is to consume more, and second is to consume better. So the consumption story has remained relevant for the last 15 years. It will remain relevant for the next 10 years out also. You just need to identify the right subsectors and the right kind of opportunities which are going to make money for you.
Fair enough. So how down will you drill down? I know it might be difficult for you to give me a stock, but since you've taken them, what subsector should I be looking at to put my wealth in, or a portion of my wealth in?
So, for example, packaged and processed food, for example, I think is going to be a big play as people become health conscious, hygiene conscious, as the Dink families, emerge, as urbanization happen. Eating out is going to be another big theme to play for.
Okay.
Entertainment is going to be another big theme to play for, right? I don't know how many entertainment players are going to survive this crisis, though. That's a different matter altogether. But
Right.
whoever does is going to be golden, right? I mean,
Right.
multiplexes, malls, shopping, brands, right? Retail. I would pick grocery retailing, for example. If you can find a good player in that, I would pay any valuation for it. So these
Got
are
it.
some of the sectors I think which are going to really ready to work. If you tell me that modern retail and e-commerce in India are going to remain stagnant at 10-11% of the total retail pie over the next 10 years also, I wouldn't agree with that at all. This is a sector that in the next 10 years is going to become at least 3 to 4 times, if nothing more.
Sure. Sure. Very interesting. One of the other, uh,
Sorry.
one of- I have a kid also who I've locked up in a room, so don't worry
Yeah.
about it. One of the other thing that sort of comes up is that during volatile times, right? People come up saying that, Jay, how much is fundamentals? How much is actually technical? How much is the emotional factor which is driving stock? What is the perception which is driving? And in a time like this, do you think looking at fundamentals for a shorter term, for a medium term, does make any sense?
No, it does. It always does, right? And that is what Coffee Can believes in. For example, if you look at now this last financial year, FY20, we delivered a positive 2% return as compared to the broader market, which kind of fell 26%. So there's a
Right.
28-29% outperformance over there. And that's primarily because we were always fundamental focused, right? You were always picking the right kind of stocks, devoid of all the emotion and the noise around you. And that's essentially what you mean when you say that you have to walk away from money making ideas, because that is a noise, that is an emotion that you're playing out on. And to remain fundamentally focused with blinkers on, I think that always pays rich dividends.
Okay.
Even now, when you think about it, when the whole world is going through so much of a turmoil, if you're able to find a company that has good corporate governance, that has great quality of management, right, is in either sunlight or a sunrise industry, and has the ability to survive this crisis, it's a golden opportunity to pick these stocks up.
Fair enough. Fair enough. And one of the things that I ponder upon while, and what sort of defined me in my journey as well, is when I started off in 2004. I'd taken these leverage commodity bets, not exactly understanding what I'm doing. And I consider those lessons that I learned by losing sort of 6 months of your salary, one of the sort
Yeah.
of the defining points, or a pivot point in at least my career. Has there been any occasion where you've paid a significant tuition fee, which has been a multiple of your salary, or what has been your learnings from those sort of stories?
So thankfully, consumption is a sector which I've always played and I've always picked in the last 15, 16, 17 years. So there's been nothing as dramatic as that.
Okay.
Uh, but yeah, there have been stocks, where you've had a significant amount of conviction and you've betted very heavily on that stock. And I remember one such name, which was in the tobacco sector, right? And I had a 3 years, 4 years back, just when the GST was about to come in, I had a very strong view on the sector, saying that this industry's issues and problems are solved forever, because the problem that you face is the excise duty increase every single year, right? So it becomes a February to February play. But GST is the same tax regime. Nothing will ever happen, right? No tax increase now, at least in the foreseeable future, which essentially means that you'll have a first time for an extended period where prices are not going to go up. That means volumes are going to go up, operating leverage is going to kick in, and it's a beautiful time to pick these stocks up.
Sure.
Unfortunately, it never played out like that. We did not lose too much money, but it did not make any money for us either. For a 3 year period, it was like a flat line.
Okay. Okay. So painful when the markets are doing well.
It is.
Okay. Okay. Fair enough.
Thankfully, it was a very small position, so it didn't hurt too much, but still.
Okay. Okay. Sure. Sure. So based on what you just said, it was a small position. So basis your philosophy, do you all sort of keep building up as the prices go up, or you all say that, look, this is 5%, and then wherever it goes, and or do you all keep sort of weight allocations happen every quarter, every 6 months, every year?
So what we do is we do a monthly assessment of risk versus reward. Valuations in absolute is immaterial to me. Just because something is 25x doesn't mean it's cheap. Just because something is 50x doesn't mean it's expensive. What you got to balance out is the risk versus reward. And we do that every month, and we actively take a call on whether to cut the weights or increase the weights depending on how the risk versus reward is playing out. Fortunately for us, the quality of the names are such that it doesn't need to happen too often, but still.
Okay. Okay. And if I have to pull you away from the Coffee Can PMS and this way of investing, where do you think, and it can be, and this is again an open-ended question, where do you see opportunities, whether it's small caps, mid caps, large caps, gold, silver, oil, etc. I tried going to the petrol pump yesterday, but they refused to give me money to buy oil. I said, but where do you see the next sort of or where would you put your money apart from the Coffee Can PMS?
So I'll answer the question in two different ways. One is
Sure.
that if you have a slightly shorter term, either a slightly shorter term investment horizon, say 6 months to 1 year, or you have a really long term investment horizon, which is 10 years, then I would bet on really good quality large cap stocks, right?
Okay.
But if you have a 3 to 5, 6 year investment horizon, I would pick mid caps.
Okay, fair
But
enough.
small caps is something that doesn't suit my risk profile at all. It's a very high risk, very high reward game.
Sure.
I typically tell people, to be cautious and think before they do it. But mid caps and large caps, I like.
Okay, fair enough. Fair enough. We've also seen in the last year and a half a lot of the flows in AUM, at least with the more nuanced investors, has shifted from mutual funds to PMSs. Do you actually think one of the reasons could be that a mutual fund now is just a closet index fund?
No, I think what is happening is that each asset class is now getting segregated for a different class of investor. Now, mutual fund is a great investment option for people who are looking to do SIPs, right? So small savings which build up over a period of time into a very large sum of money, which you start early in your career working life. With small amount of money which you can't directly use to play in the equity markets, right? It's a great sum of money. But when you think about a wealthy investor, an HNI or an ultra HNI, he has to either go through a PMS route or a AIF route because that gives him customization, right? The involvement is higher, the transparency is higher, the security blanketing is higher. So it really should be depending on what class of investor are we talking about, and each different class of investor should have a different class of asset attached to it, which is specified and molded for their needs.
Sure, sure, fair enough. I think one of when we're reaching towards the end of this sort of discussion and conversation. And one of the things, and this might be where a lot of people have started using the alternate value in investing, or the alternate avenues for investing. Having managed a sort of a long short fund, we definitely saw a lot of benefit in trying to hedge some positions, via auctions, via futures, etc. Do you think sometime at a later stage, a coffee can would raise their hands up and say that, look, uh, I want to actively have some cash management. I want to actively try and hedge a certain part of my portfolio, sort of in a certain manner, by whatever it is, futures, options, or in an alternate manner. Or would you still stick to your guns and say that, look, long term investing is the only way, very difficult to sort of do multiple things, too many moving wheels, etc.
No, we'll never hedge. Our biggest hedge is the quality of the names that we pick and the consistency of the profit growth of the businesses that you associate with. Right. That is how we build safety into the portfolio. That is what my hedge is. So no, I don't believe in long shots. I don't believe in future. I don't believe in options. I don't do all of
Okay.
that. It will always be a long-term philosophy. It will always be a long-only philosophy.
Sure. And does cash management have any future in the portfolio?
So cash management is there, and we already kind of do it when I talk about the active risk reward assessment on a monthly basis. That's what we do, right? We cut weights in the model portfolio on certain names, for example, where we feel that the valuations are too expensive or too rich, and we want to cut it back by 2 or 3 percentage points, so that at a later date when there's a cooling off which has happened, either a time correction or an absolute correction in 6 months' time, we'll come back into the stock and we'll increase the weight again. So that's essentially what we try and do. So in that sense, right, not directly, but indirectly, that cash management strategy is already there.
Sure, sure. And this is one of the, since you've got it up in terms of a model portfolio versus a portfolio that is sort of doesn't have a fixed set of this thing and is built up over, let's call it from up to a year or even a year and a half. Uh, where do you see the balance, right? Obviously, I think Coffee Can follows a model portfolio system. But do you think there are advantages also of following a non-model portfolio and build it up sort of
No,
from scratch?
absolutely. It depends on your bandwidth, right? I mean, see, the point is we have a 8 member research team. We
Sure.
have a lot of resources at our disposal. So we can do simultaneously multitask into a lot of avenues and take our time to build up a portfolio and then launch it immediately like that. But an average retail investor might actually take time researching one company at a time, one company. So that's fine, right? I mean, as long as you're sticking to the core of the philosophy and you're not deviating away from that path, I think it's a process of evolution for everybody.
Understood. Fair enough. And if there was a Manish Jain in 2020, put in his first sort of, took in client money, let's call it Jan 2020. What are the three pieces of advice that you have for him?
So do your homework really well. Don't depend on anybody else's advice. Number one. Number two, past returns are in no way a reflection into what is going to happen into the future.
Sure.
And number three is always stick with quality.
Perfect. Perfect. And anything else that you would like to mention, Mani, that we might not have covered? Anything interesting that you'd want to put forward?
I think everybody should stay at home, stay safe. Yeah, health comes first. If you stay alive, everything is going to be okay. And if you're not alive, nothing matters. All right. So with that note, I think I would say all the best and happy investing to everybody.
Perfect. Thank you so much for your time, Manish.
No, it's
It was,
always a
I think
pleasure.
it was a great session that I learned a few things as well. And hopefully our audience will too. Perfect. Thank you so much, Manish, for your time.